For Morningstar, I'm Charest. I'm coming to you from the Morningstar Investment Conference in Chicago, and I'm chatting with Ben Johnson. He is the Director of Global ETF Research here at Morningstar. Now, Ben, one of the topics being discussed at this week's conference is fixed income investing with ETFs, and it's being described in the session as the Achilles heel of index investing. Now, why does active management still have an edge? Why do so many people believe that active management has an edge over indexing when it comes to fixed income?
So what we've documented in our Morningstar Active Passive Barometer, when we look at funds across various categories, is that active managers have had an exceedingly difficult time beating their benchmarks, beating investable passive alternatives in the US equity space and certain developed international categories. Emerging markets has been a relatively better spot for them, but fixed income, it would appear, based on the data, is sort of the last bastion of active management. So in our intermediate term bond category, what we see is that success rates amongst actively managed fixed income funds have been markedly higher relative to their equity counterparts. And what I would say is that is evidence of certain structural ticks that are unique to the bond markets themselves and bond investors. Now, to put it succinctly, bonds are not stocks. Any one given issuer might have innumerable hundreds of different CUSIPs. So if I'm a corporation, I might have one single stock listed on the New York Stock Exchange, the Toronto Stock Exchange, but I might have a few hundred different bonds. So there are certain sort of structural inefficiencies with respect to liquidity, with respect to the investor base, importantly. So some investors, for example, are prohibited from investing in bonds that are rated below investment grade. If a bond is to have its credit rating downgraded to junk status, they become forced sellers of those bonds by virtue of their investment policy. That creates opportunities for more nimble, less constrained bond buyers to go out and take advantage of that forced selling. There are numerous examples like this that, again, are evidence of unique features of both bonds themselves, of the bond investor base, that create ample opportunities for active managers in fixed income.
Now, in the low yield environment that we've been in for the past several years, fees make a big difference, and that may be more of a factor in Canada than here in the United States, because the fees are so much higher in Canada. Is that enough to make up for the shortcomings of index investing when it comes to fixed income?
Yes and no. What we see is across both active and passive fixed income funds, there's certainly a fee differential, though in many cases I would argue it's somewhat narrower relative to what you see oftentimes in the equity space. So while that remains a structural advantage for indexed bond mutual funds or ETFs, it's a less meaningful advantage than it is in the case of equity funds. What I would say is the more important disadvantage is attributable in many cases to the makeup of the bond benchmarks that underlie those funds themselves, whereby in many cases they're not representative of the opportunity set that's being exploited by active managers in that space. So for example, if I were to have a bond index that was constrained to the investment grade universe within a given market, what we have seen in the past is that many active managers that are competing with that bond index fund or ETF are able to add value relative to that index simply by fishing in waters that are outside the confines of that actual bond benchmark. An important feature to understand when it comes to analyzing, selecting bond index funds and ETFs.
Good information. Thank you very much, Ben.
Thanks so much for having me.
For Morningstar, I'm Charest. Thank you for watching.